The Chinese inflation story is certainly playing into what we've been seeing globally right now. How are you viewing these numbers now, which are going to be pretty scary for the next couple of months?
That's exactly right, Yvonne. We all know about the base effects. We were expecting inflation figures to basically rise through the second quarter. Now, in addition to that, where there's a fair amount of uncertainty is the impact of rising input prices. It's certainly run well ahead of most estimates. Add to that the reopening or tentative reopening of many economies, and as services sectors kick back online, what impact does that have in terms of transitioning the leadership from the goods sector to the services sector? We may see services inflation start to pick up as well. So certainly the risk is that inflation persists for longer than we anticipate and bleeds through into the third quarter. We're seeing the market reaction to that with five-year, for instance, really poking through to that above 2.5% this morning. So inflation angst is really the dominant market narrative at this point in time.
And of course, Sue, it's not just China. We're going to see that for the rest of emerging markets as well. The question really is, at what stage will that impact debt holders? At what stage will that impact currency stability?
Exactly, Haslinda. So with domestic demand remaining very subdued right across the region, this includes even in China, the pricing power is very limited in terms of the ability of producers to pass on those higher input prices to the consumer. That being the case, margin pressures are rising. We're seeing margin squeeze right across the board in the likes of China. That differential between PPI inflation and CPI inflation has only grown wider. It's pushing around 5 to 6 percentage points now on a year-on-year basis. That is going to ultimately feed through into multiples. We have found that while the lag between margin squeezes and multiples has lengthened over the past 10 to 15 years, bear in mind that margins started rolling over in China around about the start of 2019. So we should expect to see that feeding through into the multiples very shortly.
Sue, of course it is that inflation angst that we were just talking about in the previous segment. I have to wonder, though, what do you do in terms of a portfolio at this moment? What is the right kind of protection right now? Is this something that you could have to change the next 3 to 6 months? What's your call?
It really comes down to your investment horizon. Certainly from a shorter term perspective or the 3 to 6 month perspective, we have been of the view that inflation protection would be prudent. We're not expecting inflation to peak until later on this quarter, and potentially the risk is that it spreads out to Q3. So that still remains the right trade. There is also an important distinction between reflation and inflation. Now, what we're starting to see the risk of is stagflation, which is a dirty word in a lot of monetary policy circles, but with domestic demand across many economies still very subdued, still suffering from the effects of a much more prolonged pandemic than initially anticipated, there is a risk that this supposed reflation narrative turns into the inflation narrative, and that's the angst that you're seeing in markets currently today.
So in terms of where to put your money at, right now it seems like people are just liquidating out of tech stocks in particular. Do you think that we've taken enough of the froth out of this sector? You rotate back into some of these reflation trades once again. How do you see it?
Well, we do still think that the or inflation narrative has some legs to it in the shorter term. That being the case, the rotation back to value still remains the right trade. It's how our portfolios are tilted, at least on the dynamic side, and that's paying dividends at the moment. The question, though, in the longer term is...
Go ahead.
I was just going to say that the longer term perspective, whether we do have sustainable reflation, really comes down to whether you start to see money velocity rise, whether you start to see bank loans to deposit ratios rise, and whether you see consumption growth rise. And so far, those preconditions for sustainable reflation have yet to be met.
Is the sell-off in the tech space different? I mean, the sell-off started when we had the chip shortage, but this time around, we're seeing the FANGs giving up gains of as much as 4%.
4% is really a drop in the ocean relative to how far they've come over the past 18 months and even longer if you take a longer term perspective. So we wouldn't get too worried about the day-to-day moves, but as I said, it is consistent with our expectation that we would see a continued rotation out of growth, tech being a growth sector, into value, at least in the shorter term, while reflation worries abound.
What assumptions are you making about the dollar, Sue?
We have expected that the short-term cyclical rebound that we've seen in the dollar is likely to reverse. Again, that's playing out. We have to look at what is driving that, however, given that US growth is outperforming the rest of the world quite sharply. What we're seeing is the Fed is injecting immense liquidity into the market. That has been instrumental in supporting the risk recovery from the lows. It's been instrumental in driving the dollar down from its highs from the end of March. The question is whether the Fed is really able to continue that extraordinary liquidity injections through the repo market while inflation starts to spike on a headline basis. Certainly, the longer that inflation remains elevated, the more politically difficult it will be for the Fed to maintain that inflation as transitory. Now, Powell rolled out transitory to describe high inflation back in January, so it does seem to be rather long in the tooth in terms of expecting inflation to reverse course. And really key risk event in the next couple of months will really be the lead up to Jackson Hole, which could be quite an inflection point in markets.
Okay, so that's something we're looking for in terms of inflection points. How should central banks in Asia also look into that and look at the Fed now? I mean, it seems like they're willing to overlook inflation now. Can central banks here in the region also do the same?
Well, we have been rather cautious on emerging markets, but within emerging markets, we have expected Asia to outperform from a growth perspective. The recent PMI numbers have certainly reinforced that view. In regards to inflation, it is very concerning that margins are being squeezed, and most central banks, however, do appear more concerned about limiting any undue tightening in financial conditions from rising market bond yields, for instance. The likes of the RBA, Bank of Korea, they've really pushed back in terms of the rhetoric to try and really contain any overtly sharp rise in yields. The question is the likes of Indonesia, Philippines, these central banks have actually turned to debt monetization in the recent past, and whether that is a sustainable strategy is questionable in the face of what we're seeing in terms of margins and reflation concerns.